Today we are covering one of the most fundamental skills in investing, how to read a stock chart. If you have ever looked at a stock chart and felt completely lost, you are not alone. The lines, the candlesticks, the indicators, it can look like a foreign language. But once you understand the basics, reading a stock chart becomes straightforward. Today we are going to walk through everything a beginner needs to know. What a stock chart actually shows you, the different chart types, the key patterns to recognize, and the indicators that matter most. Quick note before we get into it. Everything we cover here at Capitalists versus Consumers is for educational purposes only and not financial advice. Always do your own research and consult a qualified financial professional before making investment decisions. Please hit the like button and subscribe so you never miss a report. Let's get into it. What a stock chart actually shows you. A stock chart is simply a visual record of a stock's price over time. That is it at its most basic level. The horizontal axis, the x-axis, represents time. The vertical axis, the y-axis, represents price. Every point on the chart tells you what a stock was worth at a specific moment in time. Charts exist because humans are visual creatures. A table of numbers showing a stock's daily closing price for the past year tells you the same information as a chart. But the chart lets you see patterns, trends, and momentum at a glance that would take much longer to extract from raw numbers. The three most important things a chart tells you are where the price has been, where it is now, and what the trend has been over time. Everything else, the indicators, the patterns, the volume bars, builds on top of those three basics. The three main chart types. Before getting into patterns and indicators, you need to understand the three main types of charts you will encounter. Line charts are the simplest. A line chart plots a single data point, usually the closing price, for each time period and connects those points with a line. Line charts give you the clearest picture of a stock's overall trend, but they leave out a lot of information about what happened during each time period. Bar charts show 4 pieces of information for each time period: the opening price, the closing price, the high, and the low. Each time period is represented by a vertical bar. The top of the bar is the highest price reached. The bottom is the lowest price reached. A small horizontal tick on the left side of the bar marks the opening price. A small horizontal tick on the right marks the closing price. Bar charts give you more information than line charts but can feel cluttered when you first encounter them. Candlestick charts are the most widely used chart type among active traders and technical analysts. Like bar charts, they show the open, close, high, and low for each time period, but they display it in a way that is much easier to read visually. Each time period is represented by a rectangular body, the candle. If the closing price was higher than the opening price, the candle is typically green or white, a bullish candle. If the closing price was lower than the opening price, the candle is typically red or black, a bearish candle. Thin lines called wicks or shadows extend above and below the body, showing the high and low prices reached during the period. Most stock charts you encounter online and in trading platforms will be candlestick charts. Learning to read candlesticks is the foundation of technical chart analysis. Time frames. Choosing the right view. One of the most important decisions when reading a stock chart is choosing the right time frame. The same stock can look completely different depending on whether you are looking at a one-day chart, a one-week chart, a one-month chart, or a one-year chart. Here is a simple guide to when to use each time frame. An intraday chart, 1 day, 5-minute candles, is used by day traders who need to see minute-by-minute price movements within a single trading session. For long-term investors, this level of detail is usually irrelevant noise. A 1-week or 1-month chart, using hourly or daily candles, is useful for swing traders who hold positions for days to weeks. This time frame shows short to medium-term trends and patterns. A 1-year or 5-year chart, using daily or weekly candles, is the most useful for long-term investors who want to understand a stock's broader trend, support and resistance levels, and overall trajectory. A 10-year or longer chart, using monthly or quarterly candles, is valuable for understanding a stock's full history, major market cycles, and long-term performance. The general rule: the longer your investment time horizon, the longer the time frame chart you should be studying. A long-term investor does not need to care about what happens on a 5-minute chart. Support and resistance. The most important concepts. If you only learn 2 concepts from this video, make them support and resistance, because they are the foundation of almost every other technical analysis concept. Support is a price level where a stock has historically had difficulty falling below. Think of it like a floor. When a stock approaches a support level, buyers tend to step in, creating demand that prevents the price from falling further. Support levels are identified by looking for price points where a stock has bounced upward multiple times in the past. Resistance is the opposite, a price level where a stock has historically had difficulty rising above. Think of it like a ceiling. When a stock approaches a resistance level, sellers tend to step in, creating supply that prevents the price from rising further. Resistance levels are identified by looking for price points where a stock has reversed downward multiple times in the past. Here is the key insight that makes support and resistance so useful. When a stock breaks through a resistance level, that resistance often becomes new support. And when a stock breaks below a support level, that support often becomes new resistance. This flip is called a role reversal, and it is one of the most reliable patterns in technical analysis. Trend lines. Reading the direction. A trend line is a straight line drawn on a chart that connects a series of price points, used to identify and visualize the direction a stock is moving. An uptrend is characterized by higher highs and higher lows. When you draw a line connecting the series of higher lows in an uptrend, you get an upward sloping trend line. As long as the stock continues making higher highs and higher lows, the uptrend is intact. A downtrend is characterized by lower highs and lower lows. When you draw a line connecting the series of lower highs in a downtrend, you get a downward sloping trend line. A sideways trend, also called consolidation or ranging, is when a stock moves roughly horizontally between 2 price levels without making significant new highs or lows. This often precedes a significant move in one direction or the other. The most important thing to understand about trends is that they tend to persist until they do not. A stock in a strong uptrend is more likely to continue rising than to suddenly reverse until something changes. Trend following is the basis of many successful trading strategies precisely because of this persistence. Moving averages. Smoothing the noise. Raw price data is noisy. A stock can be in a clear uptrend and still have individual days where it falls, making it hard to see the overall direction clearly. Moving averages solve this problem by smoothing out the short-term fluctuations and showing the underlying trend more clearly. A moving average calculates the average closing price over a specific number of periods and plots that average as a line on the chart. As new data comes in, the oldest data point drops off and the average moves forward. Hence, moving average. The 2 most widely followed moving averages are the 50-day moving average and the 200-day moving average. The 50-day moving average reflects the average closing price over the past 50 trading days, approximately 2.5 months. It is commonly used to identify medium-term trend direction. When a stock is trading above its 50-day moving average, it is generally considered to be in a medium-term uptrend. When it is below its 50-day moving average, it is in a medium-term downtrend. The 200-day moving average reflects the average closing price over the past 200 trading days, approximately 10 months. It is the most widely watched long-term trend indicator. When a stock is above its 200-day moving average, long-term investors generally consider the stock to be in a healthy uptrend. When it falls below its 200-day moving average, it often signals longer-term weakness. The golden cross and the death cross are 2 of the most widely watched signals in technical analysis. A golden cross occurs when the 50-day moving average crosses above the 200-day moving average, generally considered a bullish signal. A death cross occurs when the 50-day moving average crosses below the 200-day moving average, generally considered a bearish signal. Volume. The confirmation tool. Volume is the number of shares traded during a given time period. Most charts display volume as vertical bars along the bottom of the chart, with taller bars representing higher volume. Volume matters because it confirms or questions price movements. A price move on high volume is considered more significant and more reliable than a price move on low volume. Here is why. When a stock breaks out above a resistance level on high volume, it tells you that many buyers are participating in the move, giving the breakout more conviction. When the same breakout happens on low volume, it could be a false breakout, a temporary move that quickly reverses. The general rule: volume should confirm price. Rising prices on rising volume is bullish. Rising prices on declining volume is a warning sign. Falling prices on high volume is bearish. Falling prices on low volume suggests the selling may be exhausting itself. Relative Strength Index, the RSI. The Relative Strength Index, commonly called the RSI, is one of the most widely used momentum indicators in technical analysis. It measures the speed and magnitude of recent price changes to evaluate whether a stock is overbought or oversold. The RSI is displayed as a number between 0 and 100. Traditionally, a reading above 70 is considered overbought, meaning the stock may have risen too far too fast and could be due for a pullback. A reading below 30 is considered oversold, meaning the stock may have fallen too far too fast and could be due for a bounce. RSI is most useful in ranging markets where stocks are moving between support and resistance without a strong trend. In strongly trending markets, stocks can remain overbought or oversold for extended periods, so the 70 and 30 levels should be treated as signals worth noting rather than automatic buy or sell triggers. Putting it all together. How to actually analyze a chart. Here's a simple framework for reading any stock chart. Step 1. Choose your time frame based on your investment horizon. Long-term investor, look at the 1-year and 5-year chart. Swing trader, focus on the 1 to 3 month chart. Day trader, use intraday charts. Step 2. Identify the trend. Is the stock making higher highs and higher lows? Uptrend. Lower highs and lower lows? Downtrend. Moving sideways? Consolidation. Step 3. Identify key support and resistance levels. Where has the stock repeatedly bounced from below? Support. Where has it repeatedly stalled from above? Resistance. Step 4. Check the moving averages. Is the stock above or below its 50-day and 200-day moving averages? Has there been a recent golden cross or death cross? Step 5. Confirm with volume. Are price moves happening on high or low volume? Does the volume confirm the direction of the trend? Step 6. Check the RSI. Is the stock overbought above 70 or oversold below 30? Is there any divergence between the RSI and the price action? That 6-step process gives you a complete basic technical picture of any stock in less than 2 minutes once you are comfortable with the concepts. The honest limitations of chart reading. No discussion of technical analysis is complete without an honest acknowledgement of its limitations. Charts show you what has happened in the past. They cannot tell you what will happen in the future with certainty. Every pattern that has historically worked will fail sometimes. Every indicator that has been reliable will give false signals regularly. Technical analysis works best when combined with fundamental analysis, understanding the underlying business, its earnings, its competitive position, and its valuation. A technically strong chart backed by a fundamentally strong business is a more compelling investment opportunity than either alone. And the most important thing of all, reading charts is a skill that takes time and practice to develop. Do not make significant investment decisions based on chart patterns until you have spent meaningful time studying charts, testing your interpretations, and learning from your mistakes. That is a wrap on today's breakdown here at Capitalists versus Consumers. If this gave you a solid foundation for reading stock charts, please hit the like button. It helps more people find this content. Subscribe and turn on notifications so you never miss our weekly breakdown every Friday after the close and our daily after the bell market report every trading day. We will see you in the next one. This video contains affiliate links. I may earn a small commission at no extra cost to you.